All right, today we're going to dive into the latest earnings report from Designer Brands, the company that owns DSW. And honestly, this one's a bit of a head scratcher. You've got profits going up, but sales are actually down. So this isn't just about the numbers, it's really the story of what could be a major retail turnaround.
I mean, when you first look at their Q4 report, it feels like a total paradox, right? Their profits blew past what everyone expected, but sales didn't quite hit the target. So, what's really going on here? Is this a good sign? A bad sign? Well, let's get into it.
Okay, so this table really lays out the puzzle for us. Wall Street was bracing for a loss of 48 cents per share, but look at this. They only lost 31 cents. That's a solid beat. But then you look over at revenue, and it came in just a little bit shy of what was hoped for. This mixed result is actually the key to understanding their entire strategy right now.
So, to really get what these Q4 numbers mean, we got to rewind a bit and look at the whole picture for their 2025 fiscal year. And, to put it mildly, it was a brutal year for retail. Just brutal. The company's CEO, Doug Howe, he didn't really mince words. He basically said the year kicked off with a really tough economy, and shoppers were definitely feeling the squeeze. And hey, this wasn't just a Designer Brands problem, right? It was a storm that was hitting pretty much the entire retail world. So, with all these headwinds, what did they do? Well, they didn't just go chasing sales at any cost. Nope. Instead, they focused on something they called disciplined execution, which in plain English means they decided to get their own house in order, to build a stronger, much more efficient business from the inside out. And you can really see the results of that discipline. For starters, they managed to cut $26 million in adjusted operating expenses for the year. I mean, they really tightened their belts and became a much leaner operation. They also did some serious work on their financial foundation. Get this. They paid down nearly $60 million in debt. That is a huge move, and it gives them way more flexibility going forward. And this number right here, this might be the most important one of them all. They ended the year with 6% less inventory. Now, in the world of retail, having too much stuff on hand is a total profit killer. It forces you into all these deep discounts. So by getting leaner here, they were basically protecting their profits down the road.
So, all that disciplined groundwork really set the stage. Now, let's take a look at how all that hard work is starting to show up as real positive signs of a turnaround.
Okay, before we go any further, let's just quickly define a key term you're going to hear: gross margin. Basically, just think of it as the direct profit a company makes on every single thing it sells. So for DSW, it's the cash they have left over from selling a pair of shoes after they've paid the factory that made them. Simple as that. The higher this number is, the better.
And this is where that discipline with inventory really pays off. In the fourth quarter, their gross margin jumped by 280 basis points. That's 2.8%. That is a huge increase, and it's a direct result of them selling shoes at healthier prices. It proves they're getting more profitable with every single sale.
So where is all this growth coming from? Well, this chart is super revealing. If you look at their DSW retail stores, sales were pretty much flat. But, and this is a big but, their own brand portfolio, that grew by over 5%. This right here is the heart of their new strategy. The future isn't just about selling other people's shoes, it's about building up their very own brands. And we're not talking about some generic private label stuff here. No, this is their portfolio of actual brands they've bought and are now focused on building up. We're talking about classics like Keds, the Jessica Simpson brand, and a real powerhouse in the running world called Topo Athletic.
And speaking of Topo, wow, just look at that number. 46% sales growth for the entire year. That is the star of the show, no question. And it's just proof that this whole strategy of owning and growing their own brands, it has some incredible potential.
Okay, so the discipline is clearly there, and that whole owned brand strategy, it's working. So the question becomes, how do they keep this momentum going? Well, their game plan for 2026 really boils down to 4 key things.
And here it is, straight from the top. Number 1, win with the right merchandise. Actually have the shoes people want to buy. 2, amplify the DSW brand and just make it more exciting. 3, elevate that in-store experience. And number 4, double down on what's already working, which is building and scaling their own brands. Now, a huge part of amplifying the DSW brand is a complete overhaul of their loyalty program. The CEO is talking about creating a compelling, differentiated experience.
What that really means is they want to give their best customers, who, by the way, make up a staggering 90% of their sales, even better reasons to keep coming back. So, what does all of this actually mean for you, the person shopping there? Well, you should start to see some pretty real changes. You can expect to see new and cool brands on the shelves, some stores getting a modern facelift, and, fingers crossed, a loyalty program that offers way better perks. All right, so that's the comeback plan, but what does it all mean for the bottom line, for the actual money they're making? Let's look at their forecast for the year ahead and, just as important, the potential roadblocks they might hit. This right here is what the entire plan is designed to do. So after earning just 16 cents per share in 2025, their goal for 2026 is to hit somewhere between 28 and 38 cents. I mean, that's a projection to potentially more than double their profitability in a single year. That's a pretty clear sign of confidence, if you ask me. And it's probably no surprise how they plan to get there, right? They are once again betting big on their own brand portfolio. They're forecasting another year of really strong double-digit growth from those brands. But the company is also being realistic about things. They've pointed out some pretty serious risks out there that are out of their control. Stuff like shifting international tariffs, the chance that inflation could squeeze shoppers again, and even just the fact that it's going to be harder to show huge growth late in 2026 because they'll be comparing against a stronger year. It's good that they're being upfront about this. So, here's the bottom line. Designer Brands has pulled off a really disciplined turnaround. They've found a seriously powerful growth engine with their own brands, and they've laid out a super clear plan for what's next. Internally, their strategy looks strong. But all of this is happening with the backdrop of a pretty uncertain economy. So the real question, the big question, is this. Will their smart moves on the inside be enough to fight off all those external pressures and let them truly step into a new chapter of growth?